about the merchandising operations and the multi-step income statement. So we are kind of deep diving into some, one important section at a time of the entire accounting process. Now, it's easy to get into, lost in the forest and see the leaves. So you always want to keep in mind your business context. These are all business. And then also remind yourself, this is zooming in to the part of the financial statement. So it's always thinking, okay, what are we impacting for the income statement? Today, mostly it's the income statement and how it impacts the balance sheet. So always thinking this way. And that's an important skill when you are a business owner. Okay, whatever you're doing it, how's it going to impact your income statement and how's it going to impact your financial balance sheet. Okay. And then when you're a business, your business, these numbers will impact how you borrow money, how you pay tax, how you get financing, get investors. So have this kind of mindset when you think, okay, that would be important. So business is basically, you're buying goods and services and selling goods and services, right? That's at the simplest level. So today we're talking about merchandising operations and a multi-step income statement. Okay, so it's kind of fancy term, but it's really just buying and selling. So our goal is to distinguish between service and merchandising operations. So service, you have no inventory. Merchandise, you have inventory. Okay, that's what we deal with. Okay. And then, so the operation cycle, you have the service company, you sell service, you collect cash. That's simple. Okay. And in reality, I think our economy has gone to mainly service industry. So when you look for businesses, right, business ideas, think about services. Some services, these a lot of time are opportunities. And services, most important, like customer service or timing, these are important. Like I was subscribing a software, and I call them many times, they don't pick up. It's like, okay, I'm not going to work with you. So service business, look into it. Like you ladies are the pilot business, that's awesome, right? So I think service business probably has more opportunities and it's less likely to be like becoming very competitive, right? Product in today's world, people can make products now in 3Ds and everything. So I think it's more competitive. You have to, really work hard to position something really good. Or getting something like a dirty cheap and like a Blake's business, right? In a way, it's also service business. You're basically matching, doing matchmaking. So I think a lot of opportunities in services. And also, like in account business, in my business, I have a lot of clients who are in the service business. And I like them because they know the value of service and they know the value of time. So they're willing to pay me good money. So like I, in a way, purposely position myself to serve the service businesses. Okay, consultants, doctors and professionals, coaches, merchandise companies buy inventory. So you buy inventory, you sell inventory, and you collect cash. So here we basically needed to keep a track of the inventories. That's the key. And then there are two ways of keeping track of inventories we'll talk about. One is called a periodic way, and one is called a perpetual way. So periodic way, in a simple way, is this. So in the beginning, I have 10 books, and then during this month, I bought 5 books, so that I have 15 books to sell, right? And at the end of the month, I count How many books left? Okay, 2 books left. Okay, how many did I sell? Okay, so 10 plus 5 minus 2, right? So 15 minus 2, 13 books I sold. So that's the cost. That's how you manage cost, okay? So it's very simple. Perpetual basically says, I keep track of every book I bring in. So I have 10 books, and then I bought 5 books, okay? And then whenever I sell a book, I just reduce that book, that cost. I book that cost immediately, okay? And then my inventory is always accurate because every time I sell 1 book, it's updated in the system. Okay, so 15 book, I sell 1 book. Okay, now it's 14 book. Okay, and my cost, that 1 book, is counted. Okay, so when we do the bookkeeping, we'll reduce inventory at that time. Okay, transaction by transaction. Okay, so that's the key cost. That's the simplified principle, like for this operation that I'm gonna dive into deeper. But simply, you understand this one. So the first one is called the periodical approach, and the next one is called the perpetual approach. Okay, now in reality, who do you think use the periodical and who use the perpetual? Like really the mom and pop stores, right? I mean, they don't want to keep track of it. It's, they don't have the information system barcode. So they probably just use the periodical one. And a lot of times they probably even don't count until the year end or just the estimate, right? So that's the periodical one. So the real formal ones, you want to keep track of everything on time. And then you want to do the perpetual one, right? So like, what's your name? You said your family has a store. Carolyn. So Carolyn, your family's store, do they use a periodic inventory system or a perpetual inventory system? Periodic, okay, good. Yeah. So your must be very small case, right? Very small, yeah. But once you grow and you have a lot of merchandise, it's like 7-Eleven probably they have a perpetual system, and then it help you to keep orders like that. And then gradually you probably want to, now you're educated, you go back and tell them, maybe you get a one of system, right? Like even QuickBooks has a lot of add-on system, inventory add-on systems, and you can create a barcode and then you scan it, and now you see it will help you to manage it. Like, okay, which item is selling well? Now you can order more or improve price. Right? So that's where your education comes in. You can help your business. So service company on the balance sheet, you probably have some supplies, okay? But merchandising company, you have inventory, okay? So supplies basically is just expenses. It's not something you sell, you just expense out. But inventory is something you sell. That's how you make money. Yeah. So the income statement is very simple. You have the service revenue, and then whatever depreciation expense or other sales expense, and then you come to the profit. So in the merchandising, you have cost of goods sold, and then you have a gross margin, and then depreciation expense or other expenses, and that's how it look like. And here, one thing, as a good business, you always want to have a good gross margin, okay, profitable one. So Blake's business, I think, will have a good margin. If you have good margin, even if you don't sell a lot, you still have good business. Otherwise, you just have to have a lot of, scale. Okay, so we mentioned about the periodic and the perpetual inventory system. So we have the 3 accounts are particularly important to a merchandiser. Inventory, sales revenue, cost of goods sold. So if you guys keep talking, it's gonna be distracting to me. Okay, let's just focus. I appreciate it. Thank you. So inventory, the merchandiser's total cost of acquiring goods that it has not yet been sold, right? So that's, in balance sheet. And sales revenue, that's the total sales. And cost of goods sold, it's really the same as the inventory. So you reduce inventory and you count cost of goods sold, so that you get the profit. So sales minus cost of goods sold is this. So the periodic system, basically, as we said, you have the beginning one, you plus the purchase one equal the goods available for sale, and then you count the ending inventory, whatever left. The difference is the cost of goods sold. That's a periodic one. So you can, beginning add whatever you purchased, that's the goods available, and minus the end, that's what you sold. Okay. On the other hand, you can say, okay, beginning plus the purchase equal the goods available. You minus the cost of goods sold equals the end inventory. So that's these 2 formulas. A periodic inventory system updates the inventory record for merchandise purchase, sales, and returns only at the end of the accounting period. Okay, only at the month's end or the year end. To determine how much inventory is on hand and how much inventory has been sold, periodic systems require that inventory be physically counted by the employees at the end of the period. So Carolyn, do you guys count inventories? Okay. And sometimes you see mistakes or somebody steal it. So beginning plus purchase equal goods available, and goods available minus ending inventory equal cost of goods sold. Okay, that's how the system works. In the perpetual inventory system, the inventory records are updated perpetually. That is, every time inventory is bought, sold, or returned, it immediately updates the system. Apparently, it's a better system, right? Keep track of the system. Perpetual systems often are combined with barcodes and optical scanners. Okay, these things, it's not that expensive today's world. So if you are going to do, inventories, I can guarantee you, if you use the periodic system, as you grow, sooner or later you will be confused, and you're scratching your head. It's like, okay, how much, how much inventory do I have? It kind of just based on your estimate, and everybody has their own estimate, especially now you have a team. Okay, so definitely, when it's time to spend the money to implement the system. You want to do that. Okay, and then if you go, intern or you help small businesses, you realize a lot of stores, that's their bottleneck, and that's why they haven't grown for the last 3 years, because they don't have a good inventory system, and they're always like, oh, people come, oh, we're out of stock. That's when they find out there's no more inventory, and then over time, people say, okay, we're not going to go to this store anymore. Go to another store who's better managed. Okay. So periodic inventory system, no up-to-date records, can't estimate shrinkage. Perpetual system, continuous tracking, can estimate shrinkage as well. Okay. Analyze purchase transactions under perpetual system. So we will now look at the accounting for inventory purchase, as well as transportation cost, purchase return and allowance, and the purchase discount. We will record all inventory related transactions in the inventory account. So let's say Walmart receives $10,500 bikes purchased on account. Okay, inventory increase, $10,500, accounts payable, $10,500. Okay, now this is a sold to Walmart with terms FOB shipping. FOB stands for be on board. Free of a ball. Okay, I can't remember. Basically, the point is this is like as soon as you ship it, then your job is done. So these terms imply the buyers must pay the transportation cost of $200 to a trucker. Okay, so the seller basically, the moment it leaves my warehouse, I have delivered to you. Everything else is your cost. Okay, so the buyer, if you have you pay the $200 for the transportation, you add it into the inventory. Okay, so in this way, now you increase the cost of the inventory. So when you sell it, you need to know there's $200 transportation cost you need to recoup. Yeah. So that's also a lot of small business they miss, right? And they wonder, like, why are they losing money? The more they sell, the more they lose money because they didn't count some of these costs. And plus, there's admin cost they needed to put. So the margin is too low sometimes. Inventory. So Walmart returned some of the bikes to the supplier and received a $500 reduction in the balance owed. Okay, so returned, so you reduce the inventory and also reduce accounts payable. Yeah. So credit basically says, this is the seller want to receive the money quickly. So if you pay me within 30 days, I'll give you 2% discount. Okay, and then if you pay me within 60 days, you have to pay the full price. Okay. So sales and a perpetual system, let's look at this. So merchandiser recorded revenue when they fulfill their performance obligation by transferring control of goods to a customer, either for cash or for credit. So for a merchandiser, which means the seller who's shipping goods to a customer, the transfer of control occurs at one of two possible times. FOB, shipping point, the sale is recorded when the seller loads the goods onto the truck. FOB destination, the sale is recorded when the goods arrive and are ready for unloading at the buyer's premise. So every merchandise sale has two components, each of which requires an entry in a perpetual inventory system. So basically two transactions. The first transaction is recorded the sale. So you receive cash, $800, and you book revenue, $800, right, on the income statement. Now that's actually, the income statement flows through to your balance sheet, right? That's your equity. If you look at this, you increase assets and increase equity. Coming back to the same principle of the equation, accounting equation, assets minus liability equal equity. And then the second transaction is actually book the cost. So you basically reduce the inventory and then book cost of goods sold, right? So you reduce one asset and increase another asset, you can say, or increase the expense. So now on the balance sheet, you'll see an increase of cash, $800, and then you have a decrease of inventory, $700, and then you have an increase of equity, $100 on the balance sheet. And on the income statement, you have a sales revenue, $800, and then you have a cost, $700. And then you have the net income of $100, right, which flows through to the balance sheet as equity. So if you look at this, the income statement is just the enlarged, the zoomed in balance sheet with a revenue minus expense, net assets. Okay, so we are really looking at it's only one statement. It's only always one statement. It's a balance sheet. The income statement is always periodic.
The income statement always reported before balance sheet.
Yeah. Always report before balance sheet because that number, the net income flows to the balance sheet. So without the income statement, you can't finish it. So always finish the first step. The income statement. And then what comes after the balance sheet? After balance sheet, yeah. That's it. Balance sheet, that's the whole picture of your business. That's it. Now, of course, you prepare a cash flow statement. Yeah. Which we talked before a little bit, and we can go dive in because there's a chapter on that. So the cash flow statement, it's really cash basis income statement, which basically says, how much cash I spend, how much cash came in from selling of goods, or how much cash I spend, and then what's the entry here. So that's basic cash flow statement. Okay, cash basis income statement. Okay, and now there are two methods for the cash flow statement. The first one is direct method, which is basically what I paid for my employee, how much I paid for transportation, blah blah, all of these. So that's basically exactly cash basis income statement. Okay. Now there's another method called indirect method. Indirect method basically you start with the net income of an accrued basis income statement. And then you can adjust things like, okay, accounts receivable, okay, I increase the accounts receivable, that means I didn't receive so much money, so I will, minus that. And depreciation actually is not cash out, but I calculate that. Okay, I will add that. So that's really, if you look at the cash flow statement of the indirect method, it's really a reconciliation from accrued basis income statement to cash basis income statement. Yeah. Okay, who's getting it? Who's not? Okay, nod your head if you're getting it. Okay, so if you don't get it, it's okay. Okay, I want to just do this out because these are things that the books doesn't say. These are things that are my own perspective that help me to understand. And when you understand it, actually the cash flow statement, once you read the cash flow statement, like you are probably, top 10% of all the business people. Most people don't understand that. But if you understand it, you'll be like in terms of managing your finance, you're ahead of 90% of the population. Yeah. So we'll get into it when we get into cash flow statement. Yes.
How would you pay if you use like a credit card or like a fish? How would you like entry?
So credit card in a way is accounts payable, right? Because you have to pay it. So you eventually, when at the end of the month, when the credit card comes, the statement comes, you pay it, then you release the accounts payable. Right? That's how you do it. Instead of cash, you release the accounts payable. Yeah. Good. Thank you. So Walmart sells 4 mountain bikes at a selling price of $200 per bike for a total of $800 cash. The bikes had inventory being recorded in Walmart's inventory at a cost of $175 per bike for a total cost of $700. Okay, we talk about that. You have cash increase $800. So revenue increase, and then the second journal entry is basically inventory reduce $700 and cost of goods sold, increase $700. Okay, so your net income reduced $700. Okay, are we good with this? Okay, everybody, I want to make sure everybody get this. This is the fundamental skills. Everybody get it? Not ahead, okay? Not ahead. Thank you. I appreciate that. That will help me. That counts your participation. Okay. When goods sold to a customer arrive, that's part of the fun of teaching. It's like for me, if you're getting it, it gives me a lot of fulfillment. So just interact with me. When goods sold to a customer arrive in damaged condition or are otherwise unsatisfactory, the customer can return them for a full refund or keep them and ask for a reduction in the selling price, called an allowance or discount. Okay, so that's something you will deal with if you sell products. Okay, sooner or later you have to deal with. That's another benefit of doing service business. so this way, let's just suppose that after Walmart sold the 4 mountain bikes, 1 mountain bike is returned. 1 mountain bike is returned to Walmart in good condition. Walmart would refund the $200 selling price to the customer and take the bike back into inventory. Okay, you give them $200, and then here you have sales return and allowance, $200. So in a way, that is basically reducing the sales account, right? You could just say, okay, revenue reduce $200. It's the same way. So, but in order for you to track how your activities are, so we created a different account called the sales return and allowance, because this way you know how much are returning. And if there's a lot of return, you need to ask yourself why. Okay, if your product has problem or maybe something, it's going on. Okay, so that's basically the same account. So we call contra account, basically just reducing this. Same way we did previously, we did it with depreciation, right? The contra account. Okay, so all these accounting, you think about that, it's just a way to manage your information, manage your report. And as a manager or as the owner, look at the report. Okay, a lot of sales return. Then you need to question, okay, what's the reason? Maybe because the product has defect, or maybe because your salesperson are out there, saying things without integrity, promising one thing and actually a different thing. So, and now we basically also need to clean up whatever we have booked, reverse that, because we booked reduce of inventory and then we increase the cost of goods sold, right? $175 at cost. Now we just reversed it. Okay, we add back the inventory and then we reduce the cost of goods sold. So this is how we book it. We increase sales revenue, sales return and allowance, and then reduce cash. We increase the inventory and reduce cost of goods sold. So expect return. So the month end adjustment for expected additional returns is similar to that shown on the previous slide for actual return. Differences. The refund or store gift card has not yet been given. It's only expected to be given. To report this, the decrease in cash on the previous side is replaced with an increase in a liability called the refund liability. So what this is basically, let's be conservative. Okay, when we report this, we would expect, based on our experience, 2% of the sales will be returned. So let's basically book it now, like a depreciation. Let's estimate that. Okay, so that's what the point is. This way, when we need to return money, we have the money, so we book into liability. Okay, so that's being prudent in your financial management. And again, a lot of companies, right? And a lot of persons, and I always tell people, you need to learn at least something about finance. Otherwise, sooner or later, you yourself or your business will run into financial problems. So people have a huge sale and let's party, go to Paris and spend all the money in the next month. Like, whoa, there's so much return and there's no money on the bank account. That's how you get into trouble, right? I'm not talking about the fiction, okay? I'm all talking about experience. I've seen that. As human nature, we don't think the next thing. We don't think the the rainy days. So these are things you want to learn. Okay. And I think you who've taken accounting classes, you have a different brain or at least the extra cells than the other people. Yeah. So that's how you and then you accountants, of course you'll be accused for being, conservative or whatever in your company, but you need to be proud of yourself. Stand for that. So, I had a client, he's a CFO, and everybody accused him, like Mr. No. This is Mr. No. They call him Mr. No behind his name, behind his back, because he said, no, 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 you can't spend this money. But it's important to have somebody guard that. Okay. The inventory has not been returned. It is only expected to be returned. Okay. To designate this, an account called inventory estimate return is used rather than the inventory account on previous slide. Okay. Again, we are creating this special account as an estimate. Okay. For conservative purpose. So early in this chapter, you saw that merchandiser sometimes are offered purchase discount from their suppliers to encourage prompt payment on account. In the same way, merchandisers can entice their own customers to pay promptly for sales on account by offering a sales discount, such as, I give you 20% if you pay me, I give you 2% discount if you pay me within 30 days, okay? Otherwise, you can pay, at 60 days, but you got to pay the full price. The journal entry for recording sales discount. Okay, so these we can look there. So reporting sales related transaction, you always have the sales revenue minus sales return and allowance. That's something we count as a estimate, and then that sales $600. So cost of goods sold $525. Gross profit is $75. Okay, so rather if we don't have this return, we say profit is $275. Okay, so now we created this called a sales return and allowance, $200. Now we say, okay, gross margin is only $75. So you're being very conservative. Okay, and then if the $200 return happens, you have the money to pay. You've already put aside. If it doesn't happen, hallelujah, you can write that back to revenue, recognize it as revenue. Okay. So analyze sales of bundled items under perpetual inventory system. So this bundled item basically, you sell for one price, but actually the cost is separate. So let's say it sells a vehicle equipment kit and 12 months radio service package for a combined sale price of $200 separately. The equipment and radio service sale for $100 and $150 respectively. Okay, so the cost actually is $250, but you sell for $200. So there's some discount there. Let's look at this. The performance obligation for the equipment sale is fulfilled at the point of delivery. Okay, so that $100, you can recognize it. Whereas the performance obligation for the radio service is fulfilled over the 12 months of the service subscription. Okay, so in this case, you receive the money before you deliver service, right? So we need to book what? We can't recognize revenue. We have to recognize it as well. So increase cash and increase what? As a liability, right? It's not revenue. Okay. So it's unearned revenue. It's a liability. Okay. Assume the customer pays the $200 price on October 20. The customer receives the equipment on October 31. The subscription begins November 1st. Held the equipment on its inventory at its cost, 25 cost. Okay. So you book the equipment, right? So let's look. So you book the equipment and so you sold for $200. So $200. So you separate, let's say 80% of it, 40% of the revenue is for the equipment, and the rest is 60% is 120 revenue. Okay, how did this 40 and 60? I didn't remember if I read it. Did I miss something? Or you guys read it somewhere? So basically, that's how you allocated it. That's the 80% revenue, and that cost only $35. So you can recognize profit here, $45, right? And here you have the revenue, but it's not really your full revenue yet. This is you're gonna recognize over time, right? Okay, so this is 40% equipment, 60% service. So recognize revenue when was performance. Okay, so this $10 a month every month you revenue. Okay, so you basically put into deferred revenue first, and then you recognize the reason they put deferred revenue. This is October 30, and the next day you recognize it because October 21 you deliver it. Okay, so these are things. If you're doing the exam, remember. What is your name? You're gonna pass the CP exam, right? Your name, Skyland. Okay, Skyland and Carolyn. You know, you need to pay attention to these. That's why you need to do the homework. This is October 30, but it's delivered October 31. So, you know, October 30, you need to book deferred revenue first, and then October 31, you can recognize the revenue because now you sold it. So you recognize the sales revenue $80, okay, and then you get out of the deferred revenue $80, okay, for that equipment delivery, and then of course you book the inventory, okay. So these are kind of things you will only know after you've done these kind of homework, because the exam questions are tricky, you know, just one day. But in reality, you think you go through that, right? As the boss, as the business owner, you probably tell your accountant, please don't waste this junior entry. You can just book it to revenue right away. It's a one day difference, right? That's in reality. You don't need to go through that. Yeah. Okay. So these are just the academic exercises, right? That's why I say it's a stupid exam, but you have to play the game. That's how these games. That's how these games are.
Sorry,
Yeah.
just a little
Yeah.
topic.
Yeah.
But send you the email.
Yeah.
Is it like your regular email or the email on campus?
On Canvas.
Oh, on campus?
I think it's same. Just if you send it jinhong.zhang at the tech account. So on Canvas, if you send it in a whatever you send email inbox section,
Okay.
I think I will see you.
That's fine.
Yeah.
Sweet. Thank you.
So sales of bundle item exam continue. Okay, so on November 30, this is what it, so that's where you recognize the monthly service fee, right? So you basically recognize service and take the deferred revenue out. Okay, so that's the process. Okay. So, yeah. So prepare and analyze a merchandiser's multi-step income statement. Okay, so that's where we do. So we start with the net sales, and we have the cost of goods sold. We have a gross profit. Now you have all these selling, general, and admin expense. So now you have the income from operation, and other expenses. You have the net other expenses, and then income before income tax expense. And then you have income tax expense. You get the income tax. So that's how you step by step help you to understand the cost and everything, right? So now you understand one, when you're running a business, first, of course, you want to sell a good price as much as the market can bear. Two, the cost of goods sold, that's important to you. And then, like my CPA business, the cost of goods sold in a way is like what? The labors, right? Paying to the staff. Sometimes it's very difficult to, reduce. If you want to reduce, I have to use like outsourced labors in other countries. That you have the gross profit, and then this area, selling, general, and admin expense. That's where a lot of people waste money, including myself. Okay, and that's where I sometimes click and subscribe to some things that I never use. So that's why it's good to practice when you are a new business owner to do your own finance. Look at the finance, because you will discover you waste $10 a month here, $20 a month there, and $30 a month there. It's like, whoa, I wasted $200 a month for nothing. So you discover these things, and then also you see like, oh, you thought I sometimes buy this and buy that. It's like it does not cost much, but I look at this like I add up these things. Boom! I bought so many, like 3 Sophie bars, and then like 2, 3 backpacks. It's like I don't need all of these, and it's sitting in garage. Only when you review your financials, you feel like, oh, what? I'm wasting so much money on these. Okay, so I think it's good to look at your finances in the beginning, and then you have a good sense and have a good discipline as you grow. Okay, so a lot of people, again, I come talking from experience, including myself. They're successful in their business. They're very smart. They have good sales, but they're very bad in terms of controlling cost. And then at the end of the month, at the end of the year, they're stressed because they have to pay tax and they don't have money. Okay. So these are important. You pay attention to your income statement. Also, one thing I want to say is your financial responsibility, you cannot delegate it to your accountant or to a CFO. Okay. You cannot. Nobody will care as you are. Nobody. That's the reality. Okay. Even your CFO, they're committed to just come and make their money and leave. If you go bankrupt, they'll move on to the next one. Okay. So you need to pay attention to your finance. Really, you need to look. Develop a habit of looking at the finance. I would say once a week. Okay, no longer once a month. Like no longer than once a month. You need to pay attention as a business owner. Yeah. Get that? Everybody get that. It's important. Really, really important. Okay. It's like just one habit will save you so much. I've seen people just suffer by it, because of that. Even businesses has a very high profit margin. They run into trouble because they run out of control all their expenses, especially when they have a team of people and everybody, they're just doing their job of buying this and buying that. Yeah. I mean, you need to trust the people, but also you need to watch your finance because they don't care as much as you care. Comparing profits, gross profit percentage. So here you look at each year and then you look at your profit margin. Okay. So you can do some analysis like that. So record early payment discount on purchases and sales. So record the purchase and sales discount under a perpetual inventory system. So the gross method you record it later when the cash is paid or received. Net method you record it at the time of the initial purchase sales. basically says the net method basically, I'm not going to record the discount. I'm just recording the net amount. So if it's the sales price $100 and I give 2% discount instead of booking $100, I just book $98 as my sales. Okay. The gross method basically you record $100 and then you say, okay, there's a discount of $2. Okay, so that's how it works. So let's look at this one. So in this case, assume Walmart purchased merchandise at a cost of $1,000 with terms 2%, 30 years, offered 30 days, offered by its supplier. Walmart's warehouse store then sells the merchandise to a local business at a price of $1,500 with terms of 230 offered to the customer. Walmart pays its supplier within the discount period, and the customer pays Walmart within the discount period. Okay, so the purchase, you have inventory, you have accounts payable, the whole price you put it in there, and then when payment is made, you reduce the accounts payable, and then you receive. You actually pay the $980, and then the inventory you back out $20. Okay, so that's the gross method. You book the whole thing, and then you take the discount when you pay it, and then you reduce the inventory there. Okay, reduce the cost there. So that's the gross method, and then the net method basically says, okay, instead of doing 2 steps, I'm just going to cost of goods sold. I'm just going to take it the net, 980, instead of booking 1,000 and then reduce $20 later. I'm just going to book 980, the net amount. Okay, so that's so-called the net method. So here, when payment received in discount period, accounts receivable, you reduce $1,500, and then here the cash, you receive whatever cash that's received, and then whatever difference it goes to the discount. Okay. So the net method of purchase, you're basically booking the net amount, and then we pay it. You pay it like that. Yeah. So net method of sales, you receivable, instead of say receivable $1,500, you just put into the net amount $1,407. Okay, and then also this one, instead of $1,000, you just use a 180. Okay, so when you receive the actual cash, and then you get rid of the receivable. So simple. Basically, the net method is just as if the discount is not a discount, it's just the price. So you're booking whatever it's the after discount amount. Okay, as if you've given that price anyway, as if you have given the $1,470 instead of $1,500. Okay, and then the gross method, basically, you book the sales price, and then when the discount is taken, you book that, you reduce that amount. That's basically a 2-step. Okay, so that's how it works. Okay, so this one again, not that important as a business owner. That's one of these minutia accounting exercises for your CPA exam. So this basically says, if you made an error in the cost of goods, in the inventory, say if you counted more than actual this period. It will actually this year, let's say it's you underreported your cost of goods sold, but next year, because you overcounted, so you overreported your cost of goods sold the next year. So it's kind of washes out. That's all it is. Okay. So for those of you who will pass the CP exam, you need to do several of these exercises. Okay, because it comes to the CP exam a lot. Okay, at least like 1 or 2 questions, because this is one of the things to train your thinking. Okay, so you need to do that. But for the rest of people, this is minutia. It's not like something important. Yeah. What time is it now? 2:08. Okay, let's do some exercise as well. So calculating shrinkage in a perpetual inventory system. Corey's campus store has $4,000 of inventory on hand at the beginning of the month. During the month, the company buys $41,000 of merchandise and sells merchandise that had a cost $30,000. At the end of the month, $13,000 of inventory is on hand. How much shrinkage occurred during the month? So you have the beginning inventory, $4,000, you purchase $41,000, right? And cost of goods sold is $30,000. So the ending balance should be $15,000. But you counted it, it's $13,000. Okay. $2,000 was lost. Okay, we shrink it to $2,000. And then you investigate, okay, maybe people steal it. Maybe the mouse ate it. So, in life, sometimes I had a client. They are a food company. They sell these garlic, nuts, these dry food, right? And then at the end of the year, they didn't plan well. Okay, they didn't plan well, and they at the end of the year look at the balance sheet, look at the financial statements, like whoa, a big profit, and then they need to pay tax. They came to me like, okay, we don't have this much tax, and we don't know where we spend this money, but on the income statement it shows this much income, and they have to pay tax, a huge tax liability. They panic. They came to me, okay, let's look at your business, and then eventually, okay, how can we help? How can I help you? So based on my luck and their business, maybe we can just come up with some inventory shrink. So I asked them, okay, did you count the inventory and did you have inventory loss? Yeah. How much? Yeah, whatever amount they tell me. Okay, I think we can count that and do a write-off to reduce your income. So at least, this year you don't have to pay so much tax, right? And then, next year, whatever comes, we'll deal with it. So that comes to another thing on tax. Like your story is important, your logic is important. In this case, it's food and or inventory. So I said, okay, that's something, if inventory loss, that sounds reasonable. And mouse will eat it, or it may go bad, right? So these are situations as an accountant, you're beyond an accountant. You're an entrepreneur, you're a businessman who understand accounting. So these are the skills it's important we don't learn from books. These are real life experiences. And if you are an accountant, right, you think about that, that offers a lot of value. You need to think outside the box. That's where you can help your client a lot. And they were laughing and saying, "Whoa, they were panicking and scrambling to pay tax, and you help them to save that, to solve that problem, right?" So, and just be aware of your ethical guidelines. Okay, like you don't want to, you never want to go, make up something that is totally unsupported and um, hard to explain, right? That's called a fraud. Okay, it will lose your license and then you can go to jail. Yeah. So like, you have a bottom line, you need to be careful. So watch, whatever, and including the reasonableness and all of these. That makes sense, right? And I always ask clients. I'm not going to come up with something. I ask clients, and most clients are smart enough. They understand and they know their limit also. If it sounds unreasonable, you need to question. Okay. Yeah. So that's how you do it as a business person. With smart way of doing it. Yeah. You can guide them. So interpreting changes in gross profit percentage. So the Italian company that sells Ray-Ban and Oakley sunglasses reported net sales of 17.9 billion euro in 2021 and 14.4 billion in 2020. Gross profit increased from 8.5 billion in 2020 to 10.9 billion in 2021. Was the change in gross profit caused by A, an increase in gross profit per se sale, or B, an increase in sales volume, C, a combination of A and B? Okay, so now let's look at. So the net sales, 17.9, cost of goods sold, 7, the other one is 5.9, gross profit, 10. So the gross profit percentage, 60.9, 59.1. So, here the cost of goods sold. So really the gross profit margin is, increased. Right? The profit margin has increased. In general. To identify shrinkage and other missing inventory information, calculate the missing information for each of the following. So beginning inventory, $100, purchase $700, so that's what, $800 for cost of goods sold, $300. Okay, ending inventory, $420. So you can calculate that, right? 100 plus 7, that's 800 minus cost of goods sold, 300. So the ending inventory should be 500. Now the reality is 420, so the shrinkage is 80, right? So, so these are all elementary math, okay? But for those who want to pass the CP exam, you just need to do several times so that it's easier for you. Interpreting, what time is it? Seems like you,
2:36.
okay, no hurry. So inferring missing amounts based on income statement relationship, supply the missing dollars. I think these are all good. I think we don't need to go through these. Yeah. So here's the thing. Yeah, send me email. So for people who came in late in the beginning of the class, we talked that I changed the grade 70% to be participation, right? And I think I have to answer to the school. They will think this is too much. So one thing I want to do is every class, like after class, you send me something, an email, what you learned today and how it will apply to a real life, a business in the future, like that. Okay. And this way, I can also tell, okay, the class is engaged, they're learning, they're participating. Okay. Even they don't do this much homework. So